Imagine this. You're at the car dealership, and your dream car is just a signature away. The dealer runs your credit report, and you suddenly face rejection, not because you lack the income, but because of your credit score. It's an unseen number that dictates our financial freedom more than we know. In today's world, a good credit score is like a secret key that opens doors to opportunities, from buying a house to getting favorable interest rates on loans. But how exactly can you improve your credit score? Welcome to our deep dive, where we'll unravel the myths, dive into the facts, and equip you with everything you need to know to master your credit score and, ultimately, your financial future. Let's start by cutting to the chase. What is a credit score and why does it matter so much? A credit score is a 3-digit number that tells lenders how trustworthy you are as a borrower. The most commonly used credit scoring model, FICO, ranges from 300 to 850. The higher your score, the better. Your credit score affects not only your ability to borrow, but also your interest rates, your insurance premiums, and even your ability to rent a home or get a job in certain industries. Now, if you're thinking that credit scores are for people who want loans, think again. A good credit score is a mark of financial health. It's about proving you're responsible with your money. To improve something, you first need to understand how it works. So let's talk about the main ingredients that make up your credit score. It's like baking a cake. Every ingredient matters. Here are the 5 key factors. 1. Payment history, 35%. This is the big one. Lenders want to know if you've been paying your bills on time. Even a single late payment can have a significant impact. Automate your payments so you never forget a due date, and always pay at least the minimum due. Late payments stay on your credit report for up to 7 years. The sooner you address a late payment, the better. Communicate with your lender if you're struggling. They may offer assistance to avoid a negative mark. 2. Credit utilization, 30%. How much of your available credit are you using? Ideally, you should use less than 30% of your total credit limit. Keep balances low on credit cards and consider requesting a credit limit increase, but avoid increasing your spending. High credit utilization signals risk to lenders. The lower your utilization, the better your score. Aim to pay down balances strategically. Target high-interest cards first to reduce both utilization and interest payments. 3. Length of credit history, 15%. The longer your credit history, the better. This means keeping older accounts open, even if you don't use them often. Avoid closing old credit accounts. They help build your score over time. If you're new to credit, start by opening a low-limit credit card or becoming an authorized user on a family member's account. The longer you maintain these accounts in good standing, the better your score. 4. Credit mix, 10%. Lenders like to see a mix of credit types, such as credit cards, mortgages, auto loans, etc. Diversify your credit responsibly. If you only have credit cards, consider a small installment loan to show variety. A well-rounded credit profile shows that you can manage different types of debt. This diversity reassures lenders that you are capable of handling various financial responsibilities. 5. New credit, 10%. Too many recent credit inquiries can be a red flag for lenders. Space out your credit applications. A flurry of applications can hurt your score. Hard inquiries can drop your score temporarily. Limit new credit applications to only when necessary, and consider pre-qualification options that use soft inquiries. Knowledge is power. To improve your credit score, you need to know where you stand. Monitoring your credit score regularly allows you to catch errors and identify areas for improvement. There are 3 main credit bureaus: Equifax, Experian, and TransUnion. You can get a free report from each once a year at annualcreditreport.com. Consider using apps like Credit Karma, Credit Sesame, or even your bank's tools to keep an eye on your score. Errors happen. Check for inaccuracies in your credit report, like accounts you don't recognize or incorrect balances. If you find something, dispute it immediately. Even a small mistake can affect your score. Set up credit alerts to be notified of any changes in your credit report. These alerts can help you catch potential fraud early and take swift action. Let's deep dive into payment history, since it holds the most weight. Paying on time is non-negotiable. Set up autopay for your bills. Almost every bank and lender offers this service. By doing so, you won't miss due dates. While it's always best to pay off the full balance, making at least the minimum payment keeps you in good standing. Missing payments can drop your score by as much as 100 points. Understand your credit card's grace period, which is the time between the end of a billing cycle and when payment is due. Paying within this period prevents interest charges. If funds are tight, prioritize bills that affect your credit score, such as credit cards and loans. Utilities and other bills can be worked out with providers, but missed credit payments hit your score hard. Credit utilization is a straightforward concept, but it's also one of the easiest ways to see quick improvements in your score. As a rule of thumb, you should use less than 30% of your credit limit. If your limit is $10,000, aim to use less than $3,000. Making multiple payments throughout the month can help keep your utilization low. Creditors report balances at different times, so keeping balances low whenever they report can help. If you have a high balance, consider a balance transfer to another card with lower utilization, but watch for fees. Spread your spending across multiple cards rather than maxing out one. This can help keep individual card utilization lower and boost your overall score. The length of your credit history is something that grows over time, but there are strategies to maximize it. Even if you don't use an old credit card, keeping it open helps with your average account age. Just make sure there aren't any fees associated with it. If you're new to credit, consider becoming an authorized user on a family member's account. This allows you to benefit from their longer history. Length of credit history takes time, so patience is essential. The longer you maintain accounts in good standing, the more your score will benefit. Credit mix might seem like a small part of the puzzle, but it shows lenders you can handle different types of credit. Installment loans, e.g. car loans, mortgages, and revolving credit, e.g. credit cards. Each play a role. If you only have credit cards, consider an installment loan, but only if you need it. If you have no credit or poor credit, a credit builder loan can be a great way to diversify and improve your score. Only take on new types of credit if you're confident you can manage them. Adding variety is helpful, but mismanaging debt can hurt your score more than help it. Every time you apply for credit, it generates a hard inquiry, which can temporarily drop your score. Only apply for credit when you truly need it. Each application stays on your report for 2 years. Pre-approvals are soft inquiries, meaning they don't affect your score. Take advantage of these when shopping around. When applying for loans, such as a mortgage or auto loan, multiple inquiries within a short period, typically 14 to 45 days, are often treated as a single inquiry. This allows you to shop for the best rates without heavily impacting your score. Debt management is a crucial part of credit improvement. The goal is to show lenders that you can handle debt responsibly. The snowball method focuses on paying off smaller debts first, while the avalanche method targets higher interest rates. Both methods can help reduce debt. It's about finding which works best for you. If you have multiple high-interest debts, consolidating them into one loan with a lower interest rate can help make payments more manageable. Avoid payday loans, as these loans often come with sky-high interest rates and can lead to a cycle of debt that's hard to escape. Avoid them at all costs. In extreme cases, debt settlement may be an option. However, this can have a severe negative impact on your credit score, so it should only be considered as a last resort. If you're starting with bad credit, don't worry, you can rebuild. Secured credit cards are a great option for those with poor credit. A secured card requires a deposit that acts as your credit limit, helping you build credit with low risk. If you feel overwhelmed, consider working with a non-profit credit counseling agency. They can help you create a plan to tackle your debts. If you're struggling to make payments, contact your creditors. They may offer a temporary hardship plan or reduce your interest rates. Rebuilding bad credit takes time. Stay consistent with your efforts, and over time your score will improve. Small steps lead to big changes. There are plenty of myths about credit scores. Let's bust some of them. Myth 1. Checking your credit hurts your score. Checking your own credit is a soft inquiry and doesn't affect your score. In fact, regularly checking your score is a good habit. Myth 2. Closing credit cards helps. Closing an account can hurt your score by reducing your available credit and shortening your credit history. Myth 3. You need to carry a balance. You don't need to carry a balance to build credit. Paying off your balance in full each month avoids interest and still builds your score. Myth 4. You only have one credit score. You actually have many different scores depending on the scoring model and the type of lender checking it. Each bureau may also report slightly different scores. Now that you understand the mechanics of credit scores, it's time to create your action plan. Improving your credit score is about consistent habits over time. Here's a step-by-step plan. Check your credit report. Get your free report from Annual Credit Report. And review it for errors. Set up automatic payments. Never miss a payment again. 3. Reduce your utilization. Pay down high balances and aim to keep utilization below 30%. 4. Keep old accounts open. Lengthen your credit history by keeping accounts open. 5. Apply strategically. Be selective about new credit applications. 6. Diversify if possible. Add different types of credit like a small personal loan if it makes sense for you. 7. Stay informed. Regularly monitor your credit score, be aware of any changes, and adjust your strategy accordingly. Knowledge and consistency are the keys to success. Improving your credit score isn't an overnight journey. It's about making informed, consistent choices. By understanding the factors, managing your credit responsibly, and staying vigilant, you can see real improvements in your score over time. Start today. Check your credit report, automate those payments, and take charge of your financial future. If you found value in this deep dive, hit that like button, share it with someone who could use this information, and subscribe for more content on mastering your finances. Remember, a better credit score is within your reach. It's time to take action. Your journey towards financial freedom starts with understanding and improving your credit score. Stay committed, stay informed, and remember, every positive step you take brings you closer to unlocking new financial opportunities. Let's master this together.